Hey, I'm Paul Moore. I'm the co-founder of Wellings Capital, and I'm the author of the new BiggerPockets book, Storing Up Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage. You know, the New York Times recently did an article saying that self-storage had exploded in profitability and investors are flocking to this space. So today, we're gonna talk about what I love and what my company, Wellings Capital, loves about self-storage. Self-storage is a very fragmented industry. There are over 50,000 self-storage facilities in the US. That's about the same as McDonald's, Subway, and Starbucks combined. But about 3/4 of those are owned by independent operators, and 2 out of every 3 of those are mom and pop operators. This means that they typically don't have the resources or the knowledge or the desire to increase income and maximize value. What this means is that a professional operator can come in, pay them a fair price, and actually significantly increase income and values. And then the investors benefit because adding a little safe leverage to that significantly increases return on equity. That's getting the right seller. Later, we're going to talk about how to get the right buyer. Now, self-storage is extremely recession resistant. In bad times, people are downsizing. They go through the 4 Ds, which include downsizing, divorce, dislocation, and death. And these are unfortunate times. But self-storage facilities can be a buffer for their stuff as they might downsize from a larger to a smaller house, or move, or have a parent's stuff that they need to put in storage. During good times, self-storage does well also, because people are filling up their Amazon carts or their Walmart carts, and they need a place to store their stuff. So self-storage is recession resistant, not recession proof, but recession resistant has done very well in lots of different economies. One of the reasons is sticky tenants. Now, when I say sticky tenants, I'm not talking about guys with Velcro suits, though I'm not here to judge. Sticky tenants means tenants that typically don't go anywhere. There's a couple reasons. Now, if I had a $1,000 apartment and my landlord raised the rent by 6%, I might leave rather than pay that extra $60 a month, which is $720 a year. I'm locked in. But if I have a self-storage facility at $100 a month and the landlord raises the rent by 6%, I'm probably not going to rent a U-Haul, spend a weekend, get my friends together to move my my treasures, down the street just to save $6 a month, especially since I'm on a month-to-month lease. And this month-to-month lease is a powerful driver in self-storage facilities as well, because it makes the tenant think, I'm just gonna leave in a few months anyway, I'm not locked in. This extra $6 a month is no big deal. But that tenant often stays for years, as you can imagine, especially since this is auto-billed off of their credit card or out of a bank account. Now, this month-to-month lease also is powerful because it allows the self-storage facility owner to capture inflation. Here's what I mean. If I own an office building or an industrial complex with a 10-year lease, I've already got that lease locked in for the next 10 years. And if there's a lot of inflation, it's really hard to capture that. In fact, I probably won't. The tenant will be the beneficiary. The other extreme is a month-to-month lease, which we have in self-storage, and that allows us as the facility owner to potentially raise rates to keep up with inflation. And by doing that, we can capture inflation. And as many of us know, there seems to be a lot of inflation at this point in the cycle. Now, one thing I love about self-storage too, and this goes back to the mom and pop thing, is this misperception. When I sold my company to a public company 24 years ago, I actually thought I should buy a self-storage facility. It's easy money. It's easy to run self-storage. It's just going to throw off cash. It'll be a cash cow. There's a lot of people who perceive that, and they're right in a sense, because self-storage does throw off cash every month. And we love that about self-storage. But what we found is it's easy to run a mediocre self-storage facility, but it's hard and it's intense to run a great one. And that delta, that difference between a mediocre facility and a great one, that delta can be made up by a great operator. And if that's you, or if you've invested with somebody who has, you can increase your wealth significantly. And it's this difference between the mediocre facility and a great facility that is undertaken by a great operator. And a great operator can significantly increase their investors' wealth. And we've seen this over and over. Now, one thing we love is there's a lot of low-cost value adds. Now, when I first heard about value adds in self-storage, I laughed. I was in the apartment world, like many of us. And being in the apartment world, I thought of value adds as countertops, paint, cabinets, flooring, lighting. Self-storage facilities, we're talking 4 pieces of sheet metal, a floor, and a door, and some rivets. Where are you going to increase the value? I pictured somebody coming in between tenants and sweeping out the unit, putting a lock on it, and renting it to the next tenant. Where were the value adds? Wow, was I wrong. There are so many value adds in self-storage. For example, you can do truck leasing. You can sign a contract with U-Haul and lease trucks, and that extra revenue adds significant value to the facility. You can also rent space for a billboard, an ATM, or a propane filling station, even a cell tower. These significantly increase income and dramatically increase the value of the facility. There's other value adds like ancillary sales. You can get a showroom and sell locks, boxes, tape, scissors. You can also set up tenant insurance. Insurance companies allow you to have a cooperating arrangement with them that allows you to make, let's say, $5 per month. Now that adds up over a facility with 500 units. $5 a month adds up to hundreds of thousands in increased value to the facility owner and the investors. It's very powerful. Now, since COVID, there's been a lot of demand for recreational vehicles. Boat and RV rental space is at a premium now. It's overbooked in lots of places, and this is a great value add. Just adding climate-controlled units is a great value add as well. And adding mobile units is a wonderful value add and a way to make a lot of money. The facility I'm standing at grosses $200,000 a year from mobile storage units. $200,000 a year translated into value is millions of dollars, as we'll see in a future episode. So we love the opportunity for ancillary income, for low-cost value adds, and for even adding climate-controlled self-storage and adding millions of dollars of value to the facility, increasing the image, and increasing the value. One simple value add is raising rents. Now, a lot of facilities don't keep up with rents. We talked to a facility owner recently who said they'd only raised rents 4 times in 25 years. But a great manager manages them often like a hotel or an airline. Pricing is different every day. Pricing goes up to fulfill demand. Now, a lot of these owners who don't raise rents, they're happy with 100% occupancy, but a first-rate operator can come in and buy the facility, raise rents, and significantly increase the value of the facility. Now, one of the biggest risks with self-storage is the competition. The competition who can come in next door or down the street can really put the kibosh on a self-storage facility if it's not run well. So we like the opportunity to buy value-add self-storage in locations where the land has gone up a lot in value and there's really not much chance that a competitor will come in nearby, or in tertiary or less than tertiary markets where the chance of a national competitor coming in is virtually non-existent. Now, we talked about flexible lease terms, but another great aspect to this month-to-month lease is easy evictions. During COVID, a lot of landlords experienced a lot of pain with these eviction moratoriums. That was true when you need to evict a person from an apartment or a single family home. But there's no eviction moratorium for self-storage. This is their stuff. It's much easier to enforce rental payments and evict a tenant. We've got their stuff. That is a leverage point to get them to pay their bill because they want to keep their stuff. They don't want it auctioned off. And if they do have it auctioned off, again, we can evict them and go on to a new tenant. Now, there are lots of tax benefits in commercial real estate. I think it's one of the reasons that the Forbes 400, the wealthiest people in the world, typically invest in commercial real estate. Self-storage is no different. There are a lot of tax benefits, and hopefully we'll get a chance to talk about some of those tax benefits someday. I started by talking about fragmented ownership and the opportunity to buy from a mom and pop seller. I also want to mention the other end of the equation, the buyer. A great operator knows how to put together a similar portfolio with similar marketing, similar management, similar systems, and actually sell this portfolio to an institutional buyer. Institutional buyers like Blackstone, Public Storage, and other REITs, insurance companies, hedge funds, etc., are coming in droves, and they're buying up self-storage. Now, they don't want the hassle of buying from a mom and pop. They want to have to do all those value adds. The opportunity for us to do value adds like that and package together a portfolio, selling it for a premium to an institutional buyer is very real. It can mean compressed cap rates, which can mean significantly higher prices, higher values, and return on equity to us as investors. So we love self-storage, and we're excited to be here to tell you more. Get my book. Again, it's called Storing Up Profits, and that's from BiggerPockets Publishing, or check us out at wellingscapital.com. Have a great day.